How do you hedge your physical gold in a time of falling gold prices? I have Rich Ilczyszyn of iiTrader on the line with me today. Rich, thanks for being with me.
Daniela, thanks for having me.
What a ride it's been so far, Rich.
Yeah, gold is really at a pivotal point here. I'm looking at the last price here at $13.80 after nearly a $300 drop in the last 3 days. Gold bugs, I'm sure, are scratching their head here, wondering what's going to make the market go back up. It's a tough road right here.
Well, that's the million-dollar question, Rich, is what will help gold prices bounce back? We got a bit of a recovery today. Are you confident long-term?
Well, here, Daniela, it's all the technicals. I can tell you that the trade to the downside was very technical in nature. Once we broke a 2-year low all the way back at 1525, the gates opened. And really, anybody who had physical gold or gold positions or GLD, we all looked at the same low for the last 2 years. If the 1525 would have held, I'm confident the market would have drifted back to 1600. But since it did break, what happens is stops get hit, investment funds started pulling GLD, the ETF out, and we saw a large migration of volume leaving the gold space, and then it basically opens up the floodgates to the downside where we are here today. And listen, looking at this chart, if we do break 1300, which is our next major support, we could probably get another $100 to the downside. So I'm cautioning everybody that if you have physical gold, just have a strategy here,
So fundamentals and technicals out the window, Rich, but you're still looking at 1300 as the next key level now?
Correct, absolutely. There is a big disconnect, Danielle, and really it started in the last year. We saw, debt ceiling talks, geopolitical risk with, the Eurozone, Cyprus, etc. And a lot of this, you would think that gold would skyrocket on that news, and yet it didn't. And that's where the trouble came in this year, we believe, is that gold really wasn't responding to the fundamentals. So then we start leaning on the technicals, and really the market is just, bearish here as we break that 2-year low.
But what about the whole money printing business, Rich? Shouldn't this be helping gold?
Well, listen, I don't think if you back the chart out for 10 years, I don't think that the uptrend is broken. Certainly this is a bearish market, technically from the top end of the range of 1900, the definition of a bear market, it is that. But really the uptrend is still intact, and I would say that rather than panicking out of the market here, have a strategy to either delever or hedge your portfolio risk. Most investors are recommended to at least have 5 to 10% of gold in their overall portfolio. But here, you do want to protect. Now, if you have more than that in your portfolio, if you're all into gold, you certainly want to protect your downside risk here.
So, Rich, what is some advice you can offer in terms of hedging your physical gold if we continue to go downwards? What are some tips you can offer investors?
Well, listen, this is a great question. We actually have a lot of physical gold folks as clients. We've got jewelry, we've got pawn, we've got scrap gold guys, and essentially what we did for them, and I'm going to give you a little hindsight here, is when the gold was trading above the 2-year low that we spoke about earlier, 1520, we put on what I call a cheap insurance policy with options on futures. For example, we had an indication, that if we broke that 1520, the market would go down. We didn't think it would go down this far, but in fact it did. We put out a recommendation for all of our physical gold holders to buy options on the futures here at the CME Group. We bought the 1480 puts. Now, each put has a value, a representation of 100 ounces of gold. We paid $450 per option to effectively hedge your risk in case the market broke that 1480, and it did. And those options actually skyrocketed, went up to 1,000, gained 1,000% in 24 hours. So essentially, what happens is by buying a put, when the market goes down on the CME Group, those options explode in value. So we had options that we paid $450 for just in 2 days, skyrocket to $13,000 of value in just 2 days. So if you theoretically had 100 ounces of gold, you had one option, you paid $450 for an insurance policy. The market broke, you made money here, you're losing on your physical, and that negates the risk. So essentially, folks that still have those options on are totally covered from 1480 all the way down here. And that's the only way I can see to protect yourself in this kind of environment. And really, once the market followed through on this Monday and Sunday night, it was too volatile to trade. So this is the best way to play it, is with some type of option strategy where it's calculated risk. And listen, by the way, Danielle, this is the way the big people, the big corporations, and the big companies do it. And that's why the futures and options have been designed for big commodity holders to hedge and hedge the risk. And really, we want to take out that variable cost and put it into an identifiable fixed cost by hedging the options. And it's easy to do.
So, Rich, what do you say to guys like Jim Cramer who say, look, gold shouldn't be traded. It should be used solely as an insurance?
Well, I have a hard time with that because I am a trader. And what I would say is that if somebody is sitting there at home, long gold from $1,900, and it's at $1,380 here, it doesn't feel good. And what I would say is that if you look at the chart and if you look at the technicals, this is such a technically driven market here on the cash side that why give away all that money you've made in the last 10 years in gold, and why not protect and hedge without having to get out of the market? Now, the beauty part is if you have those hedges on and the market starts going back up, close back above 1520, 1600, you take off the hedge, and then you've gotten rid of the insurance policy. And the thing that I would say about options is you don't want to have to pay for insurance until you need it, and if there's more downside, we could protect you right now for a couple $100 for an option. Why not protect your downside risk?
Good thoughts from you today, Rich. Thanks so much.
Anytime. Thank you.
And thanks for watching this edition of Kitco News. You can email me any comments or questions at newsfeedback@kitco.com or follow this conversation on Twitter at Daniela Cambone. Thanks for watching.